ultimately what I was trying to achieve with this, what I thought would be useful, is that obviously I come at things from a very, very technical perspective. You come at things from a less technical perspective. And even though you do have more of an insight into lots of the things that go on in the world of tax than most taxpayers, because of the environment that you're in professionally, you still ask the questions that taxpayers ask regularly. So I just thought it would be useful for us to just chat through. I mean, it probably would have been helpful for you to watch the CGT video first, but as a summary to what that content is put out there, the CGT content, I'm essentially saying, look, the Labour government have made no secret of the fact that they want to make changes to capital gains as a tax. They are a government that make commentary like tax has to go up, and the people who have to carry that burden are those with the broadest shoulders. And capital gains tax is considered to be a wealth tax for all intents and purposes. It's considered to be a wealth tax because it's a tax on investments and assets that, generally speaking, people who are employed and subject to income tax would never have to sustain that tax because they don't often have such assets to make disposals of. So Labour's stance on capital gains tax has, for the most part, been that they would like to bring it in line with income tax, which is huge. Like the potential impact of that is huge. If you think about the fact that income tax at the moment, top rate of income tax is 45%, where top rate of capital gains tax is 28%, and for most people the top rate of capital gains tax is 24%, that jump is huge. So HMRC, as the Labour government, have said, we want to make changes to CGT. We're speculating about what those changes might be. So one of them is a potential increase in rates such as that, and one of them is a potential reduction or further reduction in annual exemptions. So I just thought it was useful for you to, now you've heard that, you've had a bit of a chance to absorb it, how do you view that?
How do I view that? So I think probably like most of our client base and most ordinary people out there, capital gains tax to me is not about selling a business. It's not about selling shares. It's not about disposing of anything except potentially another house or another property that you have chosen to. You've either inherited that perhaps because you've had a loss in the family and you now have this property to do something with, or you have decided that in the interests of just trying to crack on a little bit, you might have the capacity to buy an additional property over and above the one that you live in and maybe do a renovation and flip that property. That is capital gains tax to what I would consider to be the broadest part of our population. Whether or not you are or not a tax client, I think that is what the masses will probably imagine capital gains tax to be. I think those that understand it to be impacting them when they sell a business at the end of their career or at the end of their growth period is much smaller.
Yeah.
So it feels to me like if you're going to tax, that should be two different taxes. It should be applied differently almost, because it should be at least your whole circumstances, your whole portfolio perhaps considered. I'm not suggesting for a second that I think just because you have done better, you should pay more. I don't technically actually believe that, if I'm honest, because I don't know that, then I'm not sure where the inspiration to go on comes from.
I think that's the difficulty, isn't it? Particularly among entrepreneurs, because we're saying here that capital gains tax captures two fairly distinct sets of taxpayers. You've got your entrepreneurial dynamic or demographic, if you will, who have built up businesses over a period of, like you say, their entire career potentially, who are then looking to exit. And those people, I mean, historically, when entrepreneurs relief, it's called business asset disposal relief now, but when entrepreneurs relief was first implemented, back when I did my exams, I can't even remember how long ago.
2 years, everyone.
Yeah, about that. Entrepreneurs relief had no upper limit, and entrepreneurs relief, just to give you kind of a summary of what that means. So on the disposal of the sale of shares in your own limited company broadly, as long as you met the criteria, like you'd owned those shares for more than, it was 12 months then, it's now 24 months, you have more than 5% of the voting rights, etc., etc. You're an employee or a director of that company and you met those criteria, when you sell your shares in your limited company, you would only be taxed at a preferential rate of capital gains tax, which was 10%. Now that, if you've built up wealth over a period of building up a business as a career, throughout that period, don't forget you've paid corp tax, you've paid national insurance, you've collected and paid over VAT on behalf of the government throughout that entire period. At the end, you're taxed on the gain that you have made, which, by the way, is going to be the entire value of that business, because when you set it up, it was worth £1. That's your base cost. So the entire value of that business is taxed at 10%. Now, any tax, any gains tax stings a little, but 10% was palatable. You could shoulder that. And then not long after that, the upper limit of entrepreneurs relief was brought down to 10 million. Now, again, there's not very many businesses that exit for more than 10 million, so it was still a beneficial tax for entrepreneurs. And then in more recent times, it's been brought down to £1 million. So now, all of a sudden, it's not that beneficial anymore. The saving...
It's already been shouldered by the broader... already been shouldered by the broader shoulders.
Yeah, exactly. So your normal rate of capital gains tax on shares is 20%. Your business asset disposal relief or your entrepreneur's relief rate is 10%. So now that they've brought that limit down to £1 million, the overall saving for a business owner that's selling their business is £100,000. That's it. That's the limit of the saving. So I think that's why we're seeing lots of people, lots of business owners, entrepreneurs who are saying, let's go offshore, let's become non-resident before we make this sale. And we're seeing it more and more and more. And in fact, we've had a bit of an influx, particularly with our partners who we work with in the Isle of Man. They have seen an influx in particular of people who have said, I want to be non-resident before the budget is announced on the 30th of October. So before they've even made any additional changes, they are forcing and pushing the entrepreneurially spirited out of the jurisdiction.
But I think they're also going to squash those that haven't got that far yet. Those that haven't started on that business journey. So let's say you're an employee of an ordinary employee, and you want to try and crack on a little bit. So maybe you do have some skills in the property sector. Maybe you do think, I know, I'll have a little go at this, and you do quite well with it, and it's worth it, and it sparks something in you, and you think, I might try this again. I might have a look into other ways that I can make my own money. Those entrepreneurial seeds have got to start somewhere.
Yeah, absolutely.
So if now it's not going to be worth it because you're considered to have the broadest shoulders because you're going to have a go, then maybe you won't have a go, and then what? Then what happens to those people who are just irregular employees, average salaries, somehow managed to get some savings together, maybe inherited a little bit of money and think, I'll put a deposit down on something, I'll have a go at doing something else. You're not going to do that if the capital gains tax is then going to take out
the time value of it.
Because it's a long process. It can take over a year to get through that process.
I suppose then it boils down to investment in pensions, but for another day. But pensions is also potentially up for a raid by Labour, and so
pensions, whilst important, when you're in a phase in your life when you're trying to grow and you're trying to do better for your family and you're trying to start on some laughable generational wealth, you're not thinking about tying it up for your own, you're not living
the return on it
today.
Absolutely, understood. And the return on that investment is potentially not as high as you could get from other investments, but also isn't accessible, is what I think.
It's not exciting, it's not entrepreneurial. All it eventually does is reduce the burden on those of us requiring benefits later on in life.
I think, though, importantly, on the topic of we've addressed that kind of what the gripe is of the entrepreneurial demographic, and as you say, it's a totally different kettle of fish for the people who are making investments in things like property, not necessarily business and shares, but yes, properties, other capital assets. So residential property actually has its own capital gains tax bands anyway that are separate to the 10 and the 20% that we've referred to here. gains on residential properties are taxed at either 18% or 24%. Recently, 24%. It was brought down to 24% in this current tax year from 28% that it was previously. And alongside that, there's also a requirement for people making sales of residential properties that are investments, that are not their private residence, to file a capital gains tax return with HMRC within 60 days of that sale. So whilst I can understand HMRC's logic there, they want to ensure that they get the tax that's due within 60 days of completion. It does kind of prevent onward investment, or it doesn't prevent it necessarily, but it stilts it a bit. So yeah, that's the concern now, is that will it create a perspective of the UK in terms of investment of an area that is not beneficial to invest in? It's not attractive for people to invest in.
Do we have any idea yet whether the capital gains tax bands will go up across the board? So they'll go up for the big players that we've talked about, and they'll go up for residential property, or do we think there's an opportunity for that to maybe remain? Is it all?
Yeah, potentially. I mean, one of the things that I've been discussing with clients, and in fact our other advisors in the industry in recent times, is the possibility of them reintroducing a taper relief. So historically, we've had a type of capital gains tax whereby the taxpayer is charged to the main rate of CGT, whatever that might be. Let's hope it's not brought entirely in line with income tax, because we'd be looking at a 45% capital gains tax, which would be, in my honest opinion, obscene. And I do tend to try and remain as positive as I can about tax as a whole, because you'll have heard me say that tax is kind of the charge that we pay to operate in a stable economic environment where no one's going to pull the rug from under us. So I do try and stay as positive as I can, but I do believe that 45% would be far too high for a capital gains tax. But yeah, there's the possibility of them implementing a taper relief. So in essence, that would impact people who'd held assets for a long period. The longer you've held the asset for, the more that rate, if you will, or the gain even, depending on how they work it, is tapered down. That's something I have seen in my career. I think when I did my exams, there was a taper relief. So it's not unheard of. So I'd welcome that, because it gives people who have built value and wealth over time a opportunity to mitigate the gains tax, whereas people who have bought and sold an asset quickly with a fast turnaround and a high gain, they would not get the indexation allowance, they wouldn't get the taper relief. So you can see how it seems on the face of it fairer. I mean, you'd still have the camp of people who argue that, well, just because I'm good at making investments, again, why am I being more heavily burdened? Because so either way, you're going to end up with a difficult conversation with those tax people. I mean, from my perspective as an advisor, what can people be doing to mitigate this risk, or to try and shelter themselves from this risk? As you know, we've seen an influx of these types of transactions. I mean, we're cutting it fine now if people want to do these things before the 30th of October, but we've seen an influx of people wanting to go non-resident. One of the issues that people are facing at the moment is there going to be an exit charge? Again, we're going to discuss that separately, because that's a whole other topic. But is there going to be an exit charge? So people want to go non-res before the announcement of the budget. And people wanting to access their entrepreneurs relief, so using mechanisms such as a company purchase of own shares to extract value up to that £1 million, access that entrepreneurs relief before it's abolished, if it is. That's speculation again.
TBC.
Those kinds of things. So people crystallising. One of the other things that I've been suggesting is that if people have got assets that are stood at a loss, that it's very unlikely that they're going to come back into profit. If we see a further reduction in the annual exemption, and just to put that in perspective for people, the annual exemption is the amount of capital gains that one can crystallise in a year without paying any CGT. Now, 2 tax years ago, I think now, that was £12,500.
So that's a little bit like your income band,
Yeah.
the first income band of £12,500
Yeah.
that you can earn before you get taxed.
Exactly.
You can do that. You can be a 40% tax bracket person in your employed job, and you could have capital gains tax
and
up to,
of 12.5k.
in which case you wouldn't pay any tax on that, but then
Exactly.
that's been reduced over the years.
It's been reduced. So it was 12.5k 2 tax years ago. It was then halved to £6,000 per annum, and then in the current tax year it's been halved again to £3,000. So whilst there is very little movement to be had on that, you know, if they halve it again, which is possible, how much impact will it have? But one of the things that we have been advising is that if people have got assets that stand them at a loss, to actually dispose of those assets now and maximise that loss, because
And what might those assets be? Are we talking
stocks and
Stocks and
shares,
shares,
crypto assets.
yeah.
I hate to be the one to say it, but crypto assets are standing a lot of people at a lot of losses recently, in particular. Although, you know what? I mean, we're not here to give investment advice, and in fact, we're not able to give investment advice. But if people do want to crystallise a loss, I would say crystallise it now, whilst the annual exemption is still guaranteed at 3k, as opposed to you might lose £3,000 worth of losses if you wait, and the annual exemption is completely abolished. So that enables you then, if you crystallise that loss, they have to be reported to HMRC within 4 years of making the loss. But then you can carry it forward and offset it against future gains, future capital gains.
in different areas?
Yeah.
So if you had crypto losses, and then you did something totally different.
Yeah.
You bought shares or something else in something else and sold
As
those.
long as it's capital, yeah, not an income tax loss. So it's to be carried forward against future capital gains.
Okay, for 4 years.
No, you can carry them forward indefinitely.
Oh.
It's that they have to be reported to HMRC within 4 years to be able to be used. So you could.
So you could sell something else. You could make a disposal of something else and not use that loss at that time.
Yeah.
You could do it again and use the loss again, and so you could keep that.
You can make the disposal, crystallise the loss, and then you would have to have reported that amount to HMRC within 4 years of making it to be able to use it against a future gain. Yeah, does that make sense?
Yeah.
So, I mean, that's where we are at the moment. So, I mean, if anyone wants to reach out in respect of anything that we've discussed, if you think anything is relevant to them, then please feel free.
Cheers.
Cheers. That was loud. Galactic.